I think we talk about whether it's extreme temperatures and hurricanes maybe are the most visible examples that we talk about weather risk. But I know one thing, our team looking at markets, trying to forecast prices and everything like that, you're always trying to look a level deeper. What are the things that maybe are kind of going on, but beneath the surface?
Welcome to the Active Energy Podcast, featuring conversations shaping the future of energy. Every episode will feature a different conversation between energy professionals on topics and questions that are at the forefront of the global energy market. It seems that every week there's a new extreme weather event occurring in some part of the world. Typhoons in Japan, drought and wildfires in California, winter storms or hurricanes. These weather events bring damage and loss to the people they affect, and they also pose a major risk to the day-to-day operations of businesses around the globe. Having a strategy in place for your business is key to helping stay the course during these events, and building resiliency and discipline into your procurement strategy is vital. On today's episode, we're joined by Senior Commodity Analyst Robbie Fraser and Senior Risk Manager Burgin to discuss the effects that extreme weather can have on your procurement strategy and the simple steps you can take to protect your business.
Hello, I'm Brian Burgin. I'm a risk manager on our commodity services team.
And I'm Robbie Fraser. I'm a Senior Commodity Analyst with our Global Research and Analytics team. I think one thing that almost everybody has noticed is frequency and intensity of hurricanes has been on the rise lately. We've had several hurricanes that you've probably heard people describe as, once in 1,000, once in 10,000 year kind of events. And we've had several of those, so the math doesn't quite add up on that. So clearly things are changing. And for energy, the impact is big, but the impact has changed a lot compared to what we might have expected just 5 or 10 years ago from the same conditions. I think, for natural gas in particular, something we look at a lot. We still talk to a lot of clients, I think, and you have this assumption that hurricanes move into the Gulf, we got all this offshore production, that's going to be bullish for prices. How much are prices going to go up because this hurricane's going to mess everything up? And really, I think the default now is totally flipped, where hurricanes are generally bearish for gas prices. You're still getting that same offshore production that's still getting impacted. It's such a smaller percentage now, though, of our total supply because of the shale boom, because it's all moved onshore. And at the same time, you tend to get kind of more mild temperatures moving in, maybe some power outages. So it hurts the demand side, and it really doesn't impact the supply side to the same extent, at least percentage-wise, that we used to see. So that's been a fundamental shift from what we're used to.
Yeah, I would say if you look at the breakdown of production today, you get about 3% of total U.S. production that comes from the Gulf, where that used to be maybe 10 years ago. That was upwards of about 20%. Now you're looking at between 20 and 30% that just comes from the Appalachian region alone to the Northeast production shale region. So a big change in that dynamic, and it has a big impact on how hurricanes impact the natural gas market.
Yeah, and I think one more way that we see it shifting too is whether it's crude, whether it's natural gas, goes hand in hand with kind of the shale boom that we've seen, but there's this export push now. We've got more and more supply, and we're shipping it out more and more, becoming a net exporter. In both cases, I think just for parts of 2019, we've become a net exporter for crude and products. Cross that line, I think, for natural gas here as well. But then, you're talking about, okay, hurricanes hitting the Gulf again. Now you're talking about exports can't get out. So before, if we're a net importer, now, then you're talking about more supplies can't get in. Just the opposite again. So in the case of, say, LNG, liquefied natural gas, where we can export, before too long, up to 10% of our, daily production can be exported from LNG. You can't get those out if the weather conditions aren't right. That's a lot more supply that has to stay in the U.S., has to be absorbed by the market here, and that's real bearish for prices.
Yeah, and even more so on the demand side, where hurricanes now, when they hit inland and southeast and within Texas, those are the two biggest markets for natural gas-fired power generation. So you take a lot of gas demand offline, and you also lower peak demand overall. So power demand tends to be lower, power prices tend to be a little lower as well. So it has a bearish impact both for natural gas demand and also peak electricity demand and power prices.
Yeah, I think one, maybe that people can think back to that, affected almost everybody in some way. Hurricane Harvey, if we just go a few years back, and all the rain and kind of devastation it brought to Houston, that's one area where your average energy consumer still saw a bullish impact because your gasoline prices, your prices at the pump went way up. And that's one where you've got energy conditions or weather conditions in the U.S. with really global implications because you've got such a huge part of global refining capacity right there in the Gulf of Mexico, particularly in Texas, right there. That refining capacity went offline with the hurricane. And so we saw crude prices actually go down because those refiners aren't buying crude anymore. So crude goes down, but your refined products, gasoline in particular, diesel, things like that, those prices went up, particularly in the U.S., but actually really around the world too, because we're that net exporter again. That really you feel that ripple effect for weather conditions here. So one question, Brian, maybe is kind of beyond the hurricanes. We've seen a lot in the way of kind of extreme temperatures and stuff like that. What are you seeing as far as just impact to energy markets, how clients are dealing with maybe some more extreme temperature conditions?
Yeah, so I think if you look at strategy overall, it's important for clients to understand how they use energy and how they on a daily basis, but on a seasonal basis as well. So I think what you're alluding to is the fact that we've had, if you kind of look at winters over the past 5 years, we've had 2014 one of the coldest winters in a century to 2016 one of the warmest, and you go back to 2012 also a very warm winter overall. So it's important to understand, particularly when you have extreme hot summers or cold winters where demand is quite strong, how you consume energy. So understanding your profile and making sure that you kind of limit peaks on demand, particularly during the highest price time of the day, that on peak period. So understanding the way you consume it, and that hopefully plays into kind of how you buy it as well. So you want to also take a higher level of cover during those peak periods, right? During those seasonal peaks, so winter, peak summer, and then ultimately looking at potentially where you do have warmer winters that can be bearish, and taking maybe a more limited cover in those periods, or non-risky periods, kind of non-peak winter, non-peak summer, things of that nature.
And one thing I think about, you almost got conflicting sort of conditions in the market right now in the U.S. where you've got more extreme weather conditions that adds risk. Certainly, but at the same time, we've got kind of this supply boom that's ongoing. When we think about oil and natural gas, of course, that carries over to power prices. How do you see clients trying to balance those two different dynamics? So if supply is strong, maybe that lowers your risk a little bit, but you got this weather risk on the rise.
Yeah, so it kind of plays into take it to the highest level. Companies need to understand their overall goals and objectives of their program, and I think. In some ways, what you're talking about can be kind of noise. So they need to kind of filter that out and really understand if they're really budget-driven, really want to limit volatility in the market, or ultimately if they are more market-driven, where they want to have the lowest price possible, and ultimately the volatility in the market doesn't have a significant impact to the overall bottom line. So they need to understand the goals of what their strategy ultimately, what they are, and then they need to be aligned internally. I think that's a real key thing that I see across organizations, at least one as far as looking at best practices, is that the procurement team is really in line with what the finance team is thinking, and ultimately the operations team as well. Everybody really understands kind of how energy impacts the business, and they're all aligned on what those goals are, and then ultimately have outlined what those tools are, right, and ultimately how they implement that particular strategy, and ultimately strive to hit those goals. So I think those are key things. Is there has been a lot of volatility, and there has been some extreme weather conditions, but I think it's also important to make sure that you're aligned on what your goals are in the strategy.
Yeah, for sure. I think we talk about whether it's extreme temperatures and hurricanes maybe are the most visible examples that we talk about weather risk. But I know one thing, our team looking at markets, trying to forecast prices and everything like that, you're always trying to look a level deeper. What are the things that maybe are kind of going on, but beneath the surface? One example that comes to my mind is drought conditions that we see. Think about Europe, what we've seen over the past year. The simple connection you make is, if you get drought conditions, then you don't have as much available for hydro generation.
Right.
And you've got certain regions of the world, not just in Europe, Brazil comes to mind, where rainfall is super important to hydro. That really connects to power prices. But then you get things like we saw in France, where river levels, river temperatures, that can impact nuclear cooling, and whether you have nuclear available. It goes well beyond just like hydro conditions.
Right.
Any thoughts on sort of like beyond that surface level weather risk that maybe clients ought to be paying attention to?
Maybe I could pose that question to you. If you look at it like from a market perspective, because I think we talked about changes in generation stack and ultimately being reliant on one fuel, and ultimately that can create volatility within the market itself. But there's also that piece of reliability for a company's perspective to make sure that if a site goes offline due to drought or flood or whatever, earthquake, that they may need to have some redundancy in other locations, or ultimately look to move production to different facilities and think about how you might handle that within a strategy. So I'm not sure which way you want to go there. Maybe you can take some of those tidbits, but I just answered the question. But yeah. And so, Robbie, looking at the different scenarios around natural disasters, right? There's been a lot of things that we've seen across Europe with drought. We've seen floods in Texas from hurricanes. We saw wildfires last year from drought in California. I mean, what are you seeing? How are those things? Are there some hidden impacts to the market there that maybe we're not seeing?
Yeah, I mean, hidden impacts are really, you could almost frame it as it's so important to understand just how interconnected, the energy market is in general. And really we see it in Europe, we see it in the U.S. Talk about water levels, we know that impacts hydro, but then you've got water levels and temperatures impacting whether or not you can cool nuclear power plants in France. Big one that we've seen really over the past 2 to 3 years has been Rhine River levels in Germany. That impacts, can you get coal downstream to coal power plants, crude products, and really you kind of go down the list, and all you're talking about is rainfall and water levels in Europe, and you can just name off just about every energy commodity, every energy power price that we track, energy price that we track is impacted in some way or another. And really, I think you talk a lot about building a strategy proactively to mitigate that risk and understand it. That's going to start with a foundation of really understanding, what are the levers that can move, when X event happens, what are all the different ways that's going to affect my energy spend, because it rarely is just this one variable that's going to end up moving.
I think one of the impacts of natural disaster, I'll use, there's two really. The recent floods in Texas this year and last year, and then last summer the wildfires in California. And we've seen where facilities have ultimately had to be taken offline there. So I think the impact to a company, maybe some of the hidden effects to companies is the fact that they have to look to replace production from that particular facility very fast, right? So I think it's important to understand or have some connectivity to where you have spare capacities where you can move production or redundancy within the company to make sure that you're able to meet sales orders and make sure that you're not taking financial risk by not being able to replace lost production. I think that's a big consideration as well. And I think overall in the strategy too, I think there's certain tools that you can use if that's a huge concern, if there's extreme financial risk there. A lot of our companies do hedge physically, but I believe taking a financial hedge approach there could potentially allow you to reallocate if a facility were to go down due to unforeseen circumstances. So the ability or the advantage of a financial hedging program is that you could just reallocate volumes across your portfolio, where if you're physically hedging and the site goes down, you could be required to liquidate. So that's additional risk that maybe you wouldn't have foreseen in a normal situation. I think a lot of the common mistakes that we see with companies and ultimately how they take positions or protect themselves against market volatility is a lot of times that there's ultimately not alignment within the organization, or ultimately it's decentralized and decision making is fragmented. So that can delay the process of ultimately taking a position when much sooner than maybe you would under those circumstances. Another one is that a lot of companies tend to really chase the market, right? So we outline goals. We ultimately set triggers related to those particular goals of an organization. They tend to really follow the market and think of themselves in terms of trading, right? Mm-hmm. versus risk management. And the reality is, when you take a position or a fixed price position in the market overall, what you're doing is taking basically an insurance policy against something that's unexpected. So it's not any different than taking out an insurance policy on a piece of equipment or the facility, right? If something goes down, you lose production, and you're protecting against that type of event. Similar thinking should be in place when you're taking a fixed price position in the energy market. Really, what you're doing is protecting something that you've outlined as being important, and you're really avoiding unexpected financial expense.
Yeah, and we mentioned pitfalls, and the thing that immediately jumps to my mind is really being reactionary. Especially you talk about things like extreme weather events. That's the one that I think most jumps out. Is you're not worried about it until it's kind of already hitting, and then the time for action is really kind of already passed at that point.
Correct.
The other one though that I would kind of tie in with weather is, I'd say, expecting the market, energy market in particular, to act the same way under the same conditions that it has historically. And there's just been so much change. Whether you're talking about changing weather patterns or you're talking about just the changing fundamentals of the market. We talked about the polar vortex in 2014 because that had such an extreme price impact, and temperatures were so extreme. But we got some polar vortex conditions last year. We got some really cold weather moving into the Midwest, and we got a price spike that went with it, right? So NYMEX gas prices went from $2.50, they double up to $5. But the thing is, it felt like about 2 weeks that we had $5 prices. They were right back to normal, and that was the difference. It didn't last. And so if you're reactionary in that market, you're grabbing kind of the highest prices of the last few years, when maybe a more nuanced understanding that we're in a much better supplied market. It's just not going to act the same way.
And that's the biggest thing in an event like that. The biggest part of my job is to take client calls and help them calm down, right? They tend to want to take long-term positions in a market that's ultimately moving strongly in one direction. In that particular case, it was moving higher. So I think that's the last thing you want to do is ultimately lock up something long-term in a market has a strong trend, right? You really want to avoid that, and we see a lot of panic in those situations. We saw it in 2014, and we saw it again actually in early 2015 too. The market started to move against us, so that tends to happen quite often. And that's really the biggest part of our job, is to say, okay, look, structurally nothing's changed. This is a weather-driven event. This is, and overall, we would expect prices to return back to a normal trading range once this event is over.
Yeah, I think that maybe kind of the final thing you can take away from that is, so if we can say just generally, across all the global markets that we might be involved in, there's this trend towards more extreme weather conditions and all that brings. It plays out differently in different markets. It's really hard to make a blanket statement of this is what it means for energy prices. You have to say this is what it means for energy prices in the U.S. under those conditions, in Europe where they've got this energy mix and everything. You have to blend that kind of regional understanding with then the kind of the broader market understanding.
Thank you for listening to the Active Energy Podcast. We're thankful that you decided to spend some time with us. If you could leave us a review on whatever platform you're listening, be sure to share with your coworkers and like-minded people, and give us a follow on social media. We're on Twitter at Schneider ESS. LinkedIn and Facebook, you can find us by searching Schneider ESS. We're also starting a LinkedIn group that is specifically for listeners of the podcast. It's a great place to interact with peers and to continue the conversation from each episode. And you can interact with the guests from each episode. Thank you for joining us. Until next time.